In the previous video, we started with some conceptual problems in demand and supply analysis. So we'll continue with the journey here. Moving on to the first question. The money spent in the past on fixed infrastructure of a plant is called, you have four different options: opportunity cost, sunk cost, variable costs, and accounting depreciation. So the money spent in the past is called sunk costs. So option B is the correct answer. The next question, diseconomies of scale translates into a long run average total cost curve with, you have three options: positive slope, negative slope, and linear slope. If I look at my graph for the long term average total costs, and if I look at point A, B, C, A to B represents economies of scale and B to C represents diseconomies of scale. So if I look at my curve from A to B, my curve is negatively sloped. So this has negative slope. And from B to C, my curve is positively sloped. So this is positive slope. So from A to B, my cost is decreasing. That is why it is negatively sloped. And from B to C, my cost is increasing. So it has a positive slope. Now going back to the question, diseconomies of scale translates into a long-term average total cost curve. In case of diseconomies of scale, the curve has a positive slope. So in this case, I go for option A. What is the slope in case of economies of scale? We saw that in case of economies of scale, the curve has a negative slope. So for this question, I go with option B. Next question. In case of inferior goods, a decrease in price would result in, you have three different options: a positively sloped demand curve, income effect dominating the substitution effect but in the opposite direction, income effect reinforcing the substitution effect. We know that in case of inferior goods, when income increases, the consumers buy less of these goods, say for example rice. Now when price decreases, demand for any kind of good increases as per the law of demand, but at the same time there is more real income when price decreases. And we saw earlier that in case of inferior goods, the income effect pulls the quantity demanded in the negative direction. So in this case, option B is the correct answer. So income effect dominates the substitution effect, but in the opposite direction. So I go with option B. Now, what happens in case of normal goods? In case of normal goods, with every rise in income, the quantity of demand for normal goods also increases. So in this case, option C is the correct answer. So I go with option C. So income effect reinforces the substitution effect. The next question, which measure is the most appropriate in determining workers' efficiency collectively? So you have three different measures: total product of labor, average product of labor, and marginal product of labor. Now, how do you calculate total product of labor? It's nothing but the total labor applied times the number of units produced per labor unit. Now, this simply indicates the firm's market share and the output volume. It does not indicate anything about the worker's efficiency. So option A is incorrect. Now going with average product of labor, how do you calculate average product of labor? It is the total quantity produced divided by the total number of labor units applied. So this indicates output per labor unit. Now this measures, so basically it's an average measure. So it measures the aggregate productivity of labor in a firm. So if we want to measure the overall efficiency of the firm, then we should use average product of labor. So in this case, we are talking about determining the workers' efficiency collectively. So in this case, we use average product of labor. So average product of labor is the correct answer. Now, which is the best measure if I want to measure the productivity of an individual worker? So here I use marginal product of labor, because marginal product of labor deals with the output generated when I apply each additional unit of labor. So this is more effective in measuring the performance of individual workers, because As each individual worker is added to the workforce, it measures the productivity of each unit of input that goes into the production. So for this, I choose option C. Now let's look at this. A company is operating in a perfectly competitive market, and suppose the company is currently enjoying significant economic profits. So which of the following statements is applicable for the firm? Now, first of all, we know that in a perfectly competitive market, the firm is a price taker and there are a lot of competitors. So the firm maintains just one single price which is dictated by the market. Now, we know that the firm is currently enjoying significant economic profits. Now, let's look at the options one by one. The marginal revenue exceeds the average total cost. So this is true. So option A is correct. The marginal revenue is greater than the price. Now this is incorrect because for perfectly competitive firms, price should equal marginal revenue. So this is not correct. Now option C, the marginal revenue is equal to the price. So this is correct. Then moving on to option D, the industry will have several barriers to entry, so there is no threat of new entrants. This is absolutely incorrect because in a perfectly competitive market, and especially when the firm is enjoying significant economic profits, the industry is highly attractive. There are no barriers to entry and there is a potential threat of new entrants. Option E, profit is maximum where price is equal to the short run marginal cost. So this is correct. To maximize profits, you should have price equal to the marginal cost and the latter is rising. So marginal costs are rising. So this is a correct option. The last one, profit is maximum where price is equal to the short run marginal cost and the latter is falling. So this portion is not correct because marginal cost is rising. So I choose option A, option C and option E. So the correct answers here is option A, C and E. The next one, currently a company is producing each additional unit at a lower cost. So what should the firm do in this situation? So option A, reduce the quantity produced, increase production, operate at its current level, or downsize and restructure. Now you know that the company is producing each additional unit at a lower cost. So this means that the company is currently operating under economies of scale. So the firm should increase the quantity of production to grow and become more efficient. So I choose option B. So the firm should increase its production because it's currently operating under economies of scale. The next problem, the following exhibit shows the number of labor hours and total productivity of labor for a firm. So you have number of labor hours and the total product. Based on this table, at what employment level does the firm experience diminishing marginal returns? So all you need to do is calculate the marginal product of labor. So I make another column here, marginal product of labor. So okay, so how do I calculate marginal product of labor? So that is nothing but the change in the total product when I increase the number of labor hours by 1 unit. So this is 50 minus 0 divided by 1 minus 0. So this is nothing but 50. The incremental product in this case is 100 minus 50. So this is 50. 200 minus 100. So this is 100. 350 minus 200, so this becomes 150. Now 300 minus 350, so this is minus 50, and here this is minus 100. So at what level does the firm experience diminishing marginal return? So I can see that my marginal return initially increases, and then after I cross 4 labor hours, I experience diminishing marginal returns. So the answer here is 4 labor hours. Let's do the next one. The exhibit below shows the cost of the firm for different levels of output. So you have quantity, you have total fixed cost, total variable cost. The question is, at what level of output is the average total cost minimum? So in order to do this, I need to first estimate my total cost, and then I can calculate my average total cost. So how do I calculate my total cost? It's very simple. Take the summation of total fixed cost and total variable cost. So I can just calculate that here. 1000 plus 0 is 1000. 1000 plus 500 is 1500. Likewise, I can do it for the rest of the cases. This is 2200, and then I have 3000, and this is 3600, and this is 4500. Now I can calculate my average total cost. So in the first case, it is not applicable because my quantity is 0. How do I calculate average total cost? This is nothing but total cost divided by quantity. So here this is not applicable. In this case, it is 1500 divided by 1. So this gives me 1500. In the next case, it is 900. Then you have 733. I just take a round figure. So it's 733. This is 750, 720, and 750. So clearly the most optimal point is at 5 units because the average total cost is minimum at this quantity. So this is the minimum average total cost, and this happens when my quantity is 5 units. So moving on to the next one. For firms operating at economies of scale but below full capacity, as more labor units are employed to generate higher output, which of the options hold good? Now we know that for firms operating at economies of scale but below full capacity, there is still scope for the firm to increase its production till it reaches the maximum capacity. Okay. Now, as more and more labor is employed to generate a higher output, the marginal productivity of labor increases. So this goes to say that the first option is incorrect because the marginal productivity of labor actually increases. So option B is correct. Okay. And what about the average variable cost? So option C is correct because as you increase the number of units produced, you tend to attain more specialization. So your average variable cost actually decreases. It does not increase. So option D is incorrect. The total costs do not decrease. So total cost never decreases. So option E is not correct. Total cost always increases. Okay, so option F is correct. Now, there's one more question here. What happens to these costs when the firm operates beyond full capacity? So, when it operates beyond full capacity, it operates under diseconomies of scale. So, in this case, option A, marginal productivity of labor diminishes. So, option A is correct. And then option D, average variable cost also increases. So, option D is correct. And finally, the total variable cost anyway increases. So here I have option A, D, and F. A firm which is operating in a perfectly competitive market will sell each additional quantity of output at a price where you have 3 different options. Now, before we look into the options, what is the condition in a perfectly competitive market? First of all, you know that price is equal to the marginal revenue. Okay. What about the average revenue? What is average revenue? My average revenue is nothing but the total revenue divided by the quantity. Okay. And you know that total revenue is equal to price times quantity. So I put that here. So this is equal to P. So in a perfectly competitive market, my price is equal to marginal revenue and my price is also equal to the average revenue. So in short, price is equal to marginal revenue is equal to my average revenue. Okay. So now let's look at the options. The marginal revenue is equal to the average revenue. This is correct. The marginal revenue is equal to the price and the average revenue is also equal to the price. So all the three options hold good. The next question, in a perfectly competitive market, a firm breaks even when you have three different options here. So before we look at the options, in a perfectly competitive market, you know that price is equal to the average revenue. We saw that earlier. So when does the break even occur? So the break even occurs when price is equal to the average total cost, and because price is equal to the average revenue, my average revenue is equal to the average total cost. So this is where break even occurs. Okay. So now if I look at the options, option C is the correct answer. The next question, a horizontal demand curve, you have three different options: zero elasticity, perfectly elastic, and it arises in imperfect competition. So this is a very simple question. A horizontal demand curve actually has infinite elasticity. So infinite elasticity, and it is called perfectly elastic demand. So perfectly elastic, and it arises in case of perfect competition. So if I look at the options, option B is the correct answer. What about a vertical demand curve? So a vertical demand curve is exactly the opposite. It has zero elasticity. It is perfectly inelastic. Perfectly inelastic. And it arises in imperfect competition. So if I look at the options, I have option A and option C, which is correct. Now look at this question. A firm which is operating beyond the minimum efficient scale of returns should do what? So when I say beyond the optimal point, the firm is actually operating under diseconomies of scale. Okay. So in this case, it should reduce the production because the returns are decreasing. And eventually, when its revenues are less than the variable costs, it should shut down. Okay. So for this scenario, the firm should actually cut down production. So option B is the correct answer. Now the next question, based on the table below, at which point will the addition of input increase the productivity at a diminishing rate? So you have labor hours here and then you have the total output. So I need to find out at which point the addition of input, so which means when I increase my labor hours, the productivity is at a diminishing rate. So here I'm actually talking about marginal productivity of labor. So let me calculate marginal productivity of labor here. So 3000 minus 2000 divided by 5 minus 4 gives me 1000 here, and this is 600, and here I have 1300, and here it has decreased, my productivity has decreased from 4900 to 4000. So which means 4000 minus 4900 gives me minus 900 and here it is minus 400. So I can see that when I increase my labor hours from 7 to 8, my marginal productivity of labor becomes negative. So since beyond 7 labor hours, my marginal productivity of labor becomes negative, my cutoff point is 7 labor hours. What is the marginal cost at 7 units of production and what is the average cost? So you have a table below, you have quantity of production, you have variable cost and you have fixed costs. So you need to calculate the marginal cost at 7 units of production. So for this, let me first calculate my total cost. So total cost. So how do I calculate my total cost? Just take the summation of variable costs and fixed costs. So let me just put down my total cost here. So this is 3,000, 4,000, and then this is 4,600, and then 5,900, 5,000, and 4,600. Now with this, I can calculate my marginal cost. So marginal cost is the additional cost incurred when I increase the quantity of production by 1 unit. So let me start from here. My marginal cost in this case is 4,000 minus 3,000. So that gives me 1,000. Likewise, I calculate for the rest of the cases. So this becomes 600, then 1,300 minus 900 and minus 400. And then I need to calculate my average cost. So average cost is nothing but the total cost. So this is total cost divided by quantity. So I just use the formula simply here and get the values. So this becomes 750, 800. This is approximately 767 and this is 843 and 625 and 511. So now the question is at 7 units of production. So when I'm here, what is my marginal cost? So at 7 units of production, my marginal cost is 1,300 and my average cost is 843. So marginal cost is 1,300 and average cost is 843. This is for 7 units. Now let's look at this. In case of normal goods, a decrease in price will result in what? So you have different options here. Now let's look at the first option, the income effect to reduce the substitution effect. This does not happen in case of normal goods. This is only for inferior goods. So this option is not correct. Then consumers demand more of the good, producing a negatively sloped demand curve. So demand curve is always negatively sloped except in case of exceptions like the Veblen goods or Giffen goods. So here this option is correct. So because it's a normal good, when you decrease the price, the quantity demanded increases. Now moving on to the next option, consumers demand more of the good, producing a positively sloped demand curve. So this is not correct. The demand curve is always negative in case of negatively sloped in case of normal goods. The income effect and the substitution effect reinforce each other, producing a negatively sloped demand curve. So this is absolutely correct because in case of normal goods, the income effect actually reinforces the substitution effect. So this is the correct option. Finally, the income effect and substitution effect reinforce each other, producing a positively sloped demand curve. This is not correct. The next question. For a firm operating in perfect competition and at the most optimal point of efficiency on the long run cost curve, Which of the following statements are correct? So remember here, the firm is operating in perfect competition and it is at the most optimal point of efficiency, which means if it further increases the production beyond this optimal point, then it goes into diseconomies of scale, right? So right now it is at the most optimal point, so which means it is operating under constant returns to scale. Okay, so the first option, diseconomies of scale, no. The firm is experiencing constant returns to scale because it is already at the most optimal point. The firm is experiencing economies of scale. This is not correct because there is no scope for this firm to further increase production. It is already at the most optimal point. The firm needs to reduce quantity and reduce its cost to be viable in the long run. This applies only in case of diseconomies of scale. So under constant returns to scale, this is not a correct option. A company manufactures 3 different goods, A, B, and C, and you have the characteristics of these 3 goods as shown in the table. So you need to find out which good has the highest elasticity and which has the lowest elasticity. Now let's look at the characteristics one by one. And let's start with good A. So percentage of consumers' budget spent on the good is 90%, which is very high. And we know that when the percentage of consumers' budget spent is very high, it makes the good highly elastic in nature. Okay. Secondly, the number of substitutes are too many. And also good A is durable in nature. So all of these 3 characteristics make good A highly elastic in nature. So this is highly elastic. Coming to good B, the percentage of consumers' budget spent on the good is relatively lower. So here the elasticity could be lower than good A. Number of substitutes for the good is very few. So this makes the good highly inelastic in nature. And also you can see that good B is non-durable. So these 2 characteristics make the demand for good B highly inelastic. So this is highly inelastic in demand. Now good C, the percentage of consumers' budget is only 10%. So this makes the good inelastic in nature. But the number of substitutes are many, which contributes to the elasticity of demand. And durability of the goods, if I look at this, it is non-durable, right? So I can say that the elasticity of demand for good C will be lower than good A, but higher than good B, mainly because it has many substitutes. Okay, so which has the highest elasticity? Good A has the highest elasticity and good B has the lowest elasticity. So this is good B. Good C will have medium elasticity. So it will be higher than good A but lower than good B. Now look at this question. When marginal costs are lower than the average total costs, which of the following options hold good? Okay. Now under these conditions, we can say that the firm is operating under economies of scale and there is a decrease in the total cost of the firm. Considering that the fixed costs are constant, the variable costs also decline. So this is a case of economies of scale. So let's look at the options now. Average total costs increase. No, this is not correct. Variable cost increase. There is actually a decline in the variable cost. So variable cost cannot increase. Variable costs fall. This is correct. And average total costs fall. The next question. The production manager of a company observed that increasing the price of a specific class of jewelry has led to an increase in the sales of that class relative to the other categories. So clearly, in this case, when the price of the good has increased, the sales of that particular good has also increased. So this definitely means that we are talking about Veblen goods. So this is the correct option for this question. A company boosts the sales of its coffee makers by selling at 10% reduction on its price. Currently, the company sells 500 units per month for a selling price of $200 per unit. After the price reduction, the company expects to sell around 600 units per month. So you need to calculate what is the marginal revenue associated with the price decrease. So let's try to solve this. So I'll try to make two different columns. So this is my current situation. And this is after price reduction. Okay, so what is my current situation? Currently, my price is at $200 and my quantity is around 500 units. So let me calculate my total revenue. My total revenue is price times quantity. So this is 200 times 500. So which gives me 100,000. After price reduction. So what is my price reduction? It is 10%. So which is 10% of 200. So which is equal to 20. So my new price is equal to $180, which is 200 minus 20. Okay. And what is my quantity now? It is 600 units. So I can calculate my revenue here. My revenue is 180 times 600, which is equal to 108,000. Now I can calculate my marginal revenue, which is nothing but the change in revenue divided by the change in quantity. So this is equal to, my change in revenue is 108,000 minus 100,000, this whole thing, divided by my change in quantity is 600 minus 500. So if I calculate this, I get $80. So this is my marginal revenue. Which of the following characterizes the Giffen goods? So you have different options here. A positively sloped demand curve. Yes, we have seen that Giffen good is actually an exception to the law of demand and it has a positively sloped demand curve. Negatively sloped demand curve does not apply to Giffen goods. Income effect reinforces the substitution effect. In fact, there is negligible substitution effect in Giffen goods and income effect is very strong for Giffen goods. So this is not correct. Income effect negatively impacts the substitution effect. This is correct. A negligible impact of substitution effect on the demand curve. This is also correct. Now moving on to the next one. The total revenue for a monopolist is what? Is it a linear curve, a non-linear curve, or rises when the demand is elastic and declines when the demand is inelastic? Now, you know that a monopolist operates under imperfect competition, right? So under this condition, the total revenue curve is actually non-linear. We saw that in our discussion earlier. We looked at the graphs for imperfect competition. So we saw that the total revenue curve is non-linear and when the demand is elastic, the quantity demanded increases exponentially with every decrease in price. So as a result, my total revenue increases. But beyond a certain point, when the demand becomes inelastic, the change in quantity demanded is at a much slower rate as compared to the price decrease. So the total revenue decreases. So in this case, let's look at the options. It is definitely not linear. It is a non-linear curve and it rises when the demand is elastic and declines when the demand is inelastic. So option B and option C are the correct ones. The demand for beverages increases with an increase in the price of ice cream. So beverages and ice cream are what? You have 4 different options here. So let's first analyze the situation. So I have beverages here and I have ice cream here. So it is given that when there is an increase in the price of the ice cream, so here price increases. So obviously, as per the law of demand, if price increases, the quantity demanded will decrease. And when quantity for ice cream decreases, the demand for beverages increases. So here I can see that my quantity increases. So for one good, the quantity increases. For the other good, the quantity decreases, which clearly goes to show that they are substitutes. So these are substitutes. So option A is not correct. Option B, they are substitutes. The demand for beverages will shift upward and to the right with an increase in the price of ice cream. So increase in the price of ice cream has actually increased the quantity demanded for beverages. So definitely we can see an upward shift in the demand curve for beverages, and it is towards the right. So this is the correct option. Will it shift downward and to the left? This means a decrease in demand. So this is not correct. The total revenue curve for a monopolist is, you have different options here. So let's first look at the total revenue curve for a monopolist who is operating in imperfect competition. So I have my total revenue, I have my price, quantity, and my marginal revenue. So this is my total revenue curve. You can see that this is not linear. So my option A is ruled out. Now, if I look at this curve, somewhere here, my total revenue is maximum, and beyond that, if I further increase the quantity produced, then my total revenue shows a declining trend. So from here till here, my demand is elastic in nature, and beyond this point, my demand will be inelastic in nature. Okay, so as long as my demand is elastic in nature, my total revenue curve will increase, my total revenue will increase, and when my demand becomes inelastic in nature, my total revenue shows a declining trend. Also, if I look at the marginal revenue, so my marginal revenue is positive till 5 units of production in this case, and if I further increase my production from 5 to 6, my marginal revenue becomes negative. So as long as my marginal revenue is positive, my total revenue will show an increasing trend, and when my marginal revenue becomes negative, my total revenue starts declining. Now, considering all of this, let's look at these options. So rises when the demand is inelastic? No, when the demand is inelastic, my total revenue actually falls. So this is not correct. Declines when the demand is inelastic? Yes. Rises when the demand is elastic. So I'm referring to this region here. So this is correct. Rises when marginal revenue is positive. So from here to here, when the demand is elastic, my marginal revenue, you can see it is positive. So this is correct. Declines when marginal revenue is negative. So when my marginal revenue becomes negative, the demand becomes inelastic and my total revenue comes down. So this is also correct. This is a very straightforward problem. So for 200 units, you can earn 400,000, and for 400 units, the revenue is 600,000. So you need to calculate marginal revenue. So let me put it like this. So I make two different columns, quantity and revenue. So this is my quantity, and here I put revenue. So for 200 units, I generate a revenue of 400,000, and for 400 units, the revenue is 600,000. So my marginal revenue is the change in revenue divided by the change in quantity. So this is 600,000 minus 400,000, the whole thing divided by 400 minus 200. So it's a very simple calculation. So this gives me around $1,000. So this is my marginal revenue. A company projects its long-term earnings to be around 8 million. Okay, so that is my revenue. At what level of costs should the company stay in the short term but shut down in the long term? So you have different options A, B, and C, and you have variable costs and you have fixed costs. So you need to find out at what level should the company shut down and at what level should the company stay in the short term. Okay, so let's look at each of these options one by one. So let me start with option A. In case of option A, what is my total cost? This is 4 million plus 3 million, which gives me $7 million. And what is my total revenue? My total revenue is 8 million. So my condition here is total revenue is greater than my total cost. So definitely there is a profit and the company should operate in the long run. So this is a very profitable scenario. So definitely the company should operate. Now look at option B. In case of option B, my total cost has increased. So now it is 7 plus 1.5, which is 8.5 million. And my total revenue remains the same, which is 8 million. So what is the situation here? My total revenue is definitely less than the total costs, so which means it is not very profitable, but at the same time my total revenue is greater than the variable costs. My variable cost is 7 and my total revenue is 8. So definitely the company should operate in the short run. So it should operate because it is at least able to cover some of the fixed costs. So it should operate in the short run and exit in the long run. So exit in the long run. Now look at the third option, option C. So in this case, what is my total cost? My total cost is 8.5 plus 0.5, which is very high, 9 million. And my total revenue is only 8 million. So definitely it is a loss. And what is my variable cost here? It is 8.5 million. So my total revenue in this case is less than my variable cost. So the firm should immediately shut down. Immediately shut down. So if the firm is not even able to cover its variable cost, it should immediately shut down even in the short run and long run. Which of the following characterizes the demand for Veblen goods? So an upward sloping demand curve. So you know what is a Veblen good? So as in when the price of such goods increases, the quantity demanded also increases because they are considered as status symbols. So definitely this has an upward sloping demand curve. A negligible impact of substitution effect on demand. So this is also correct because in this case the law of demand does not hold. So there is very negligible substitution effect for these kind of goods. Negatively sloped demand curve? No. This has an upward sloping demand curve. Eventually the demand curve will become negatively sloped. So if you consider a long run, then as and when you increase the price beyond a certain limit, then slowly the quantity demanded for such goods will start falling.